Hi everybody, and welcome back to video number 6 in chapter 15. One last note on this illustration. Note too that Acctg does not restate shares issued after the stock dividend because they are on a new basis. Okay. All right, here's another illustration. Brooks Enterprises computes its weighted average number of shares as 100,000 for the year ended December 31, 2025. On January 15th, 2026, before issuing the financial statements, the company splits its stock 3-for-1. What is Brooks' weighted average number of shares after the stock split? Well, in this case, the weighted average number of shares used in computing earnings per share for 2025 is now 300,000, computed by taking this 100,000 and multiplying it by 3. If providing earnings per share information for 2024 as comparative information, Brooks must also adjust it for the stock split. Okay. Let's put it into practice. Bryson Corporation has income from continuing operations of $580,000 and a gain on discontinued operations net of tax $240,000. In addition, it has declared preferred dividends of $1 per share on 100,000 shares of preferred stock outstanding. The changes in Bryson's common stock shares outstanding during 2025 are as follows. So here we start with 180,000. We purchased 30,000 shares for the Treasury. We had additional shares due to a 3-for-1 split on July 1. We issued another 50,000 shares for cash. So our ending balance was 500,000. They want you to compute Bryson's earnings per share and indicate the presentation of the earnings per share on the face of the income statement. Okay, so in computing the earnings per share, here's our outstanding shares of 180,000. Let's go back. Here's that 180,000. And it went through April 30th, so that's 4 months of the year. So we'll weight that. And then from May 1 to June 30th, we increased by 30,000 shares, or decreased by 30,000 shares for the Treasury stock. Okay. And then from July to the end, we had 6 months of 450,000 shares. So the weighted average number of shares outstanding, 480,000. In computing the weighted average number of shares, they ignore the shares sold on December 31, 2025, because they have not been outstanding during the year. Since Bryson, let's go back here, we're ignoring that. Okay, the preferred stock dividends are subtracted from income from continuing operations to arrive at income available to common stockholders. So we'll take the 580,000 given in the problem here, back out preferred stock dividends, and divide through by 480,000, which we calculated here, giving us $1 of basic earnings per share. But we had a gain on discontinued operations of 240,000 net of tax. We'll divide that through by the weighted average shares, and that's 50 cents. So that means that we have net income of the sum of the two of $1.50. Okay. Bryson must disclose the per share amount for the discontinuing operations net of tax, either on the face of the income statement or in notes to the financial statements. The income and per share information are reported on the face of Bryson's income statement as shown on this slide. Okay, I think that's clear. We'll move on. Now, diluted earnings per share. Here we have our earnings per share basic, but we now need to look at the impact of convertibles and the impact of options, warrants, and other diluted securities. Companies will not report diluted earnings per share if securities in their capital structure are anti-dilutive. Dilutive. I'll get it out. Anti-dilutive. Okay. Convertible securities. We're going to measure the dilutive effects of potential conversion on earnings per share using the if converted method. This method for a convertible bond assumes 1, the conversion occurred at the beginning of the period or at the time of issuance of the security if issued during the period, and the elimination of related interest net of tax. Little tricky there. Let's take a look at an example. Mayfield Corporation has net income of $210,000 for the year and a weighted average number of common shares outstanding of 100,000 shares. The basic earnings per share is therefore $2.10. The company has 2 convertible debenture bond issues outstanding. The first one is a 6% issue sold at 100, total of $1 million in a prior year, and convertible into 30,000 common shares. The second one, a 10% issue sold at 100, total of $1 million on April 1 of the current year, and is convertible into 36,000 common shares. So, what is the adjusted net income for the numerator of Mayfield's diluted earnings per share? The tax rate is 20%. Okay. So to determine the numerator for diluted earnings per share, Mayfield adds back the interest on the if converted securities, less the related tax effect. So here's the income for the year, and we're going to add the adjustment for interest. The 6% debentures will take 60,000 times 80%, which is 1 minus the tax rate. And 10% ventures, we're going to take 9 months of that, again, times 80%. And that gives us adjusted net income. Okay. And, okay, so I think that's clear. Mayfield assumes that it pays no interest on the convertible bonds during the year. The interest on the 6% convertibles is $60,000, and I think clear here. Mayfield issues the 10% convertible bonds after the beginning of the year. So, in other words, it considers these shares to have been outstanding from April 1 to the end of the year. That's why it's 9 months here. The interest added back on the 10% convertible is $60,000. And that's the $1 million times 10% times 9/12 of the year times the 80% after-tax factor. So the final item in the calculation shows the adjusted net income. This amount becomes the numerator for Mayfield's computation of diluted earnings per share. All right, same facts here. What is the weighted average shares outstanding in the denominator of Mayfield's diluted earnings per share? And bravo, How will Mayfield's earnings per share be reported in its income statement? Okay, Mayfield calculates the weighted average number of shares outstanding as follows. We've got 100,000 weighted average number of shares outstanding. Then we add the shares assumed to be issued. We have the 30,000 given in the problem as of the beginning of the year, but we had another 36,000 issued in April, so we're going to take 9/12 of that 36,000, which will give us 27,000. So we add that together to get 157,000 weighted average number of shares adjusted for diluted securities. So I think that's clear, and we'll move on. Okay, under Bravo, in its income statement, Mayfield's going to report basic and what I call fully diluted earnings per share as follows. Here's the net income and our basic earnings per share, which we calculated at $2.10. And finally, we take the numerator and denominator that we calculated for fully diluted earnings per share, and that comes out $2.03. It's always the case that the fully diluted earnings per share will be less than the basic earnings per share. And the reason is we know that convertible bonds are dilutive. Okay, another example. The Curry Company issued a convertible bond on January 1, 2024 with a conversion rate of 10 common shares for each bond starting January 1, 2026. Beginning January 1, 2029, the conversion rate is 12 common shares for each bond. Beginning January 1, 2033, it's 15 common shares for each bond. So the question is, what conversion rate should you use in computing Curry's diluted earnings per share? And the solution is in computing diluted earnings per share in 2024, Curry is using the conversion rate of 15 shares to one bond, which is the most dilutive current conversion rate given here in the problem, not the 12 here, the most dilutive conversion rate. Okay, so the Curry Company had 100,000 shares at $5 par, 6% cumulative preferred stock outstanding all year. Each share of preferred stock is convertible into 7 shares of common stock. Curry Company had net income of $1.5 million and 300,000 shares of common stock all year. Okay? What is the basic and diluted earnings per share? So here we'll take the 1.5 million and back out $30,000. And we get that by taking the 500,000, that's 100,000 shares times the $5 par, and multiply it by 6%. 6% cumulative, right? So we back out that and divide through by the 300,000 shares of common stock. So that's pretty straightforward at $4.90. Now, the basic earnings per share in this case then is, if I have 1.5 million in common stock and we have basically converted, then we're going to have the 300,000 shares of common stock plus the 700,000 converted shares from the preferred stock, which is the 100,000 times 7. That looks like a good place to stop this video, and when we return, we'll continue on. Until that time, bye for now.